Well, I know at least 3 different friends of mine that are waiting on appliances, and they're like using laundromats because their washer and dryer kicked out, and like it's December to get a replacement.
Yeah,
we
wild. Talked about that a few weeks ago with that when the Whirlpool CEO announced they were out 6 months in terms of delivering dishwashers from a normal 2-week delay because they had to space out all their employees in their factories, slowed down their entire production lines.
For sure. Well, hey, I'm getting the cue to let her rip here, so I'm going to get us started. So welcome, everyone. This is our weekly update, and this week we're live. So we were actually able to pull off the live show pretty much flawlessly. That's technically, of course, I won't speak for our performances, but we were able to do a pretty good job last week. So we thought, why not do this one live so we can get the most current information out to you guys and answer your questions directly. So as always, I'm Ken Adamo, Chief of Analytics here at DAT, joined by the conflagrant Ned Damon,
Flagrant
Data Scientist.
I know what a conflagration is, but I gotta look up what that adjective.
Yeah, I was worried about the pronunciation. It's not a word I use daily. I'm also joined by Dean Croke, Principal Industry Analyst at DAT. So welcome, guys.
Thank you.
Howdy.
So similar format, just live. We're going to go through our key points of the week. We are going to hear about the market update from Dean. Ned is going to walk us through forecast models. We have some really interesting stuff to talk about there this week. And then we have a great conversation, a new addition to the show. Cynthia O'Rourke, one of our data scientists, sat down earlier.
Dr. Cynthia O'Rourke, thank you.
Sat down with Ned and talked about some of the interesting stuff coming down the pike for Ratecast. So I'm really looking forward to that. But jumping right into our key points of the week, dry van rates just continue to surprise. They're reaching their highest recorded levels in 5 years. And I think if you went back even further, it's probably the case. This is just the sample period we pulled. These rising rates are attracting carriers to the spot market. You see more carriers searching for spot market loads and more spot market loads posted last week. Contract rates are also starting to climb. I shared a chart out onto my LinkedIn network yesterday. And if you're interested in getting the data behind that, let us know. But contract rates are starting to accelerate behind. And we think a lot of that is mini bids shifting down the routing guide and some other factors playing into account there. But spot rates are still well above contract. And then COVID-19 is just adding to shipper delays and disrupting capacity. We started the show talking about appliances and things like that. So without further ado, I'll turn it over to Dean to get into the nuts and bolts of our market update.
Yeah. Okay, Ken, thanks. Let's dive into the numbers behind some of those highlights. Let's start with the load board activity. The dry van load to truck ratio last week increased by about 2%. Not a big jump, ended at about 5.84 loads per truck. It was driven primarily by a 5% increase in load posts. This is about double this time last year, which is unseasonably high. It's tracking very close to 2017. And that was when capacity started to tighten, leading into that capacity crunch we saw in 18. So watching that very closely. About 3% more trucks searched for loads last week on the dry van load boards, attracted by rising spot rates, as Ken mentioned. The reefer load to truck ratio, very little change last week, only moved up about 1%, tracking very close to 2017 levels, as you can see the red and yellow lines on the chart. Load post volumes are about double 2019 also, and it's the highest level in 4 years. Very little change in reefer capacity. Trucks searching for loads last week are about the same level they've been for the last 5 weeks. So capacities remain relatively flat on the refrigerated side. Shifting to the flatbed side, not a lot of change there either. Fairly flat week for both load posts and truck searching. They both increased by about 1% nationally, and like reefer, tracking very close to the LTRs of 2017. Shifting over to the market condition index, we see a very different picture this week. The MCI in the West Coast is on fire in more ways than one as they deal with worst fires on record, specifically in the Pacific Northwest. I took a look at the Medford market this week. Inbound volumes are up 15% last week. What's interesting in that market, about 30% of inbound loads come from Seattle, so those trucks run back empty. But about 50% of all loads out of Medford head to Southern California. And what that does is it creates it creates tighter outbound capacity. So as a result of the tighter southbound capacity into Southern California, rates moved up about 1% to $2.44 a mile. Moving further south on the MCI, Los Angeles and Ontario volumes dropped back 16% week over week, but capacity on the supply side is still tight. Rates moved up 2% to $2.32 a mile for dry van. Moving over to, I've lost my place here. Moving over to refrigerated, the Pacific Northwest market of Twin Falls, Idaho, very interesting market this week. The USA reported a shortage of trucks hauling potatoes and onions out of there. As a result of the latter part of summer, reefer volumes were up about 14% week over week and 85% month over month. So very strong volumes, but capacity is very tight out of the Twin Falls market. Rates were up about 6% to $2.16 a mile. Interestingly, about 12% of all loads out of that market head to Ontario, California. On the East Coast, melon season is still causing capacity problems for growers and brokers in the Carolinas. They've had a shortage of trucks there for the last 4 weeks, even though volumes are up about 10% week over week. Rates are up 7% to $2.35 a mile. A lot of that volume out of the Carolinas heads to the two big destination markets of Minneapolis and Lakeland, Florida. Closing out the market condition index on the flatbed side, as we expect, a lot of activity in the southeast after Hurricane Laura ravaged the Gulf Coast. We expected outbound volumes last week out of the Gulf Coast to be fairly low after the devastation. Volumes outbound dropped 32% last week. Most of the flatbed activity was on the inbound side into the Gulf Coast. In contrast, inbound volumes jumped 40% into the Gulf Coast market last week. Outbound rates were also up 6% to an average of $2.55 a mile. So closing out with our year-over-year look at spot rates.
Hey, Dean, before you get to spot rates, I had a question, not to interrupt you.
You're right.
So the two big things that I have kind of in my mind on the West Coast coming up are grapes and apples, right, to support the wine business, and then apples coming out of the Pacific Northwest.
Right.
Do you think the fires will have much of an impact on that as we head into the fall?
It's hard to say at this stage. Normally, we don't see it on the supply side. Trucks can run pretty much all the time, provided the I-5 is not shut down. It could have an impact if the fires get closer to those particular areas. So I think that remains to be seen. Normally, though, I haven't seen it, Ken.
Okay, thank you. Sorry to interrupt you.
Yeah, right, no problems. We're certainly in unprecedented times in many ways, certainly on the climate side. On the dry van spot rate side, year-over-year view, we can see that we're at record levels. Rates climbed last week. They're about 28% higher than this time last year. They peaked out at $2.18 a mile. As Ken said, they're the highest level in 5 years. And I took a look at this. The rates have increased from the low point during the pandemic lockdown. They've increased 62 cents a mile in just 5 months in what's regarded as the longest continuous rate rally that we've seen in 5 years. And on some lanes like Los Angeles to Dallas, rates have almost tripled since the low point in April when they were $1.11 a mile, excluding fuel surcharge. They're up around $3.16 a mile today in rate view. So a lot of volatility in markets and some strong upward pressure that's continuing. On the reefer side, year-over-year spot rates, national average increased 3% week over week, still at fairly high levels, bumped up on $2.35 a mile before the Labor Day breaks, also the highest level we've seen in 5 years. There were higher volumes of truckload produce domestically last week, which is a bit of a turnaround. We should note, though, that the week before Labor Day is always a massive holiday volume and sales week in the grocery and fresh fruit produce department. So not surprising to see higher volumes leading into Labor Day. Closing out with the flatbed spot rates year-over-year view. Flatbed rates reported the smallest weekly movement of all three equipment types. They only moved up 4 cents a mile to $2.13. What I noted there was that the spot market rates for flatbed jumped quickly early last week, but then leveled off for 5 of the 7 days at the same rate. So a little bit of a flattening off in the rates there, unlike reefer and dry van. So that's it for the supply and demand update. Ned, what's the week look like for the rate forecast?
Well, this week we have kind of a mixed bag. We have some forecasts that I find really exciting, and we have some other forecasts that have been kind of trending in the same direction. So let's get started with the ones that are more sort of what we've seen out of 2020 so far, and that's the dry van spot forecast. So in blue, you can see the actual market rates observed by DAT. And then off on the right side of the graph, you can see the set of models that we have. We have in green the Ratecast model, and then we have 2 blended forecasts that are mixtures of the Ratecast model and the short-term forecast in different amounts and in different ways. The short-term forecast is expecting that the trends are going to keep trending up and to the right. And basically from everything that I've seen in 2020, I see no reason to doubt the almighty short-term forecast. So up and to the right is my expectation, at least moving forward. Ratecast is expecting a little more of a mean reversion, but I'm not seeing it. I'm not seeing it right now.
We might be able to kick this around at the end when we have a little bit of discussion time, but I mean, 225 a mile nationally, excluding fuel, seems like the next friction point, right? Just kind of looking at Dean's charts and then this, kind of where the blended and even the blended forecast seem to rub into some friction there. I mean,
yeah, no, I mean, I have some ceilings on the forecast that, at least for the short term and the blended forecast, that will tend to saturate when you get much closer to 250 a mile. But we'll see what happens.
Yeah, for sure.
Was there more to that question that I cut you off?
No, I'm struggling to, when the fundamentals don't necessarily support, we're just, when does it end? I mean, I know it was kind of a 2020 comment about the red line, but it's like,
yeah, no, I honestly don't know. If you had told me, and I've consumed a hat to prove it, but if you had told me back in April that we'd see like a sustained up and to the right, almost pure linear trend with even like super linear growths at some periods through August, September, I would have thought you were joking, but here we are.
Yeah, I mean, I think the total amount of times the words black swan were used in the April, May time period would not have indicated this kind of rally in the second half of the year. Anyhow, sorry to derail you.
No, not at all. Always interested to discuss the finer points of what's going on here. So we're going to move next to the reefer forecast. Same structure where at least from what the lines represent, where the blue is the actual market rates observed by DAT. And then off to the right, we have our model suite, red being the short term, green being our ratecast, and yellow or gold and gray being our blended forecast. Here, this is very interesting because we have a much tighter agreement between the various forecasts. And I think that's kind of driven by a little bit of slowdown in the short-term forecast combined with a little bit of an expectation for a continued upward motion in our ratecast forecast. But then they cross over in late September with short-term continuing the up and to the right motion and ratecast expecting things to level out and then drop. Here is something that I'm really interested to see because the reefer supply side is just so heavily seasonal. There's a real question about whether or not the seasonal trends will win out over the kind of unusual patterns that we've been seeing. But I'm not making any more bets this year, at least on that. Throwing out betting altogether is a bridge too far. Moving forward to the flatbed rates. Here you can see there's at least a fair bit of model agreement up through the end of September. And then there's disagreement. Obviously, the ratecast model is a little more pessimistic and the short-term model is a little more optimistic. If you are a more kind of chart-focused person, you might say that there appears to be a little bit of a bump that might be indicating a leveling off or a flattening starting in early September in this flatbed chart in the blue and the actual market rates observed by DAT. But I suspect that bump is going to prove to be a little bit illusory, like the one we saw in late June, early July. But we'll see. And I think that rolls us forward to the Ask IQ question of the week.
Yeah, thanks, Ned. Appreciate that. So our question this week was more a summary of a bunch of questions we've been getting, which is what's next for Ratecast? What are we working on to improve it? We released it this spring. Our customers have been grinding on it. We're talking at this point probably hundreds of millions of queries ran through Ratecast, but kind of our commitment to building product. What are we doing to advance it? So we're going to roll a quick sit down that you had, Ned, with Cynthia. Explaining some of the more interesting things coming down the pike. Yeah.
So I've been hearing a lot from our sales folks that people are happy with Ratecast, but they're also interested in seeing what the next thing is that we're going to be developing for Ratecast. So to answer that question, I brought in Dr. Cynthia O'Rourke, another member of the DAT Data Science team. Cynthia, how you doing?
I'm good, Ned. How are you?
For a 2020 baseline, not so bad. I got some folks working on cleaning up the old garbagey fence that was in my backyard. And so they're hammering and sawing and jackhammering and, stuff, loud noises, power tools. It's been a blast. I'm surprised that you're so positive considering the fire is throwing up huge clouds of ash over the greater Portland metro area.
Yeah. I have an HVAC system, so I am extremely fortunate in that regards. And I can just look outside, and it looks blue sky. It looks beautiful outside. Just don't go out there.
It's pretty grim, but that's the foresight that we look for in the DAT data science team, getting an HVAC installed.
Yes.
So we're going to be rolling a feature into live testing tomorrow in Ratecast called interpolation, where the goal behind interpolation is trying to fill in periods where we have missing data, either because of late contributions or because of just a lack of shipment on a particular lane. Where interpolation, as kind of a broad summary, is looking at the rest of the data and using that to try and fill in and make an educated guess of what should be in the holes. It's particularly useful on lanes where there's very strongly sporadic or seasonal loads. And Cynthia did the initial work on it. So do you want to talk a little bit more about why you feel like interpolation is such a good improvement to the Ratecast system?
Well, it increases accuracy, and that's good. And it also increases our coverage, so our ability to forecast more lanes than we currently forecast. And to give you kind of an analogy for how interpolation works, let's say that you work for a company in retail sales, and you have 5 years of sales data, and you want to predict out into the next year of data, but you're missing December 2017. So a way that you can make an educated guess about the December 2017 sales is to look back at the overall 2017 sales, see that they were high, and then see that your December sales in general are high. And based on those two pieces of information, you could make a guess that your December 2017 sales were also high.
That would be a really nice circumstance. I think everybody is interested in high sales during the holiday periods, but we do have some strong safeguards in place to ensure that when we're filling in the data, when we're introducing any kind of a new feature or new functionality into Ratecast, that we're actually improving the model. And that's through our testing suite. So we have roughly 3 major steps of testing. The initial set of testing we call lab testing, and that's when we have an idea. We test it on a fixed set of data or a canned set of data. And this allows us to try out a bunch of different ways of looking at something, just kind of experiment and see if there's kind of a pony in the pasture, as another data scientist on the team, Jen McClam, likes to say. And then after we've bench tested it and shown that there is a real live pony there, or at least a pony-shaped object, the next thing that we do is we bench test it to let it run on live data, on a subset of live data that's representative of the full suite of data that our model runs on. And we observe how that behaves over a period of time. So this, we've sort of locked down exactly what we're going to do, and we're just letting it run on a smaller set of the data that comes in every day, a smaller set of the lanes that come in every day, to see that it's actually improving things in a live format. And then once bench testing has proven useful, or has shown that, to continue the analogy, the pony eats oats, we move on to the live testing. So that's where interpolation and Ratecast is going to be headed, hopefully tomorrow, assuming that everything goes well, where the customer doesn't see it, at least initially, but we're running it in the shadows alongside the main model. We're kind of taking that pony out for a ride, and we're making sure that it won't throw us off, and that there's no real problems with the system as it's designed and as it's deployed. Did I miss anything, Cynthia?
No, I think you summed it up. I've identified something that looks pony-like, and I've handed the pony off to you, and you are now proofing that the pony is indeed present in the pasture across all of our forecasted lanes. And this will, as it has in the lab environment, improve accuracy and allow us to expand our coverage across the full suite of lanes that we forecast with Ratecast.
Yeah, and I think that's one of the big challenges about building new features and new functionality for the Ratecast model, is that there's so many different lanes and they all behave so differently, that trying to find improvements and make adjustments that are strong enough to stand up to kind of the full suite of tests is both important and an interesting challenge. But speaking of bench testing, I hear that there is another pony that has been proofed in the lab, a pony-shaped object that you've been working on. Do you want to tell us a little bit about that?
Yeah, I'm pretty excited about this one. So we have a product, Market Conditions Index, and that indicates the balance of supply and demand in the freight market. So it's an alternative to using load to truck as a straight product. We add some additional variables and some cleaning steps, and it also kind of takes the temperature of the trucking environment. So is there more demand for trucks, or are trucks more in demanding loads? So I've done some initial testing, again, in the lab on a subset of lanes and a subset of time periods. And Market Conditions Index, MCI, does appear strongly predictive of our rates in this controlled lab environment. And so I'm handing that off to you now to do that broader bench testing across a full suite of lanes and across a longer time period to see if that pony is indeed a pony.
I believe that there's a pony, but sometimes you do get a donkey. And I think that that's part of the data experience.
That's the uncertainty of it. That is the explorative nature of data science. That's what makes it a science.
Yeah. Well, I think you did a really good job summarizing everything that we've got going on. And thank you very much for taking the time to be on the show.
Thanks, Ned. It was great to be here.
Yeah, no, maybe you'd like to take over for a while, and then I can sleep in some of these days.
Yeah, that's okay.
All right, fine.
Yeah.
All right, I see how it is. All right, back to you, Ken.
All right, wow, that was a very equine forward discussion, but I think it speaks, I'll get on a little bit of a soapbox, just to the overall transparency and kind of dedication that we have towards continuous improvement, right? We put out something and, the claim to fame is that a couple of weeks out, it's 95% plus accuracy. It's like, that's not enough, because there are areas where it's not as accurate. Maybe it's those less dense lanes. Maybe it's during some of these weirder seasonal events, right, Ned? And that's why we're putting in the effort to kind of bolster our flanks across, all of our customer experiences.
Yeah, I would say that one of our goals is to try and match the functionality and match the kind of stability that the RateView engine provides. And part of that is working to make sure that we're always improving and we're always doing our best to incorporate new findings or just make things better. Like interpolation was something, and MCI as an exogenous variable was something that we intended to be in the initial model, but we wanted to get something out there and see and just sort of let people experience it rather than trying to make a perfect gem before it got dropped.
And Ned, I say this a lot, so I want to kind of live fact check myself with you, the expert. So what makes all of this possible is the RateView database, right? The ability for us to score ourselves against actual data is the advantage, correct?
Yes. Yeah. No. Having, I know I've said this before on the show, but to really stress it, it's tough. In my opinion, it's basically impossible to do good data science without having a really deep breadth of data, because otherwise you really run the risk of overfitting. You run the risk of sort of focusing in on the features, on aspects of your model that aren't actually describing the fundamentals. And the fundamentals are kind of where everything comes from. And the RateView database being so comprehensive and having such like a deep bench is what lets us knock on these things in all different directions and make sure that what we're introducing is going to be an improvement across the board.
Right. So it kind of keeps you from blasting out rates on social media that are off by over $1 a mile outbound from Los Angeles, right? That kind of stuff.
Ooh, yeah, no, I would feel bad if I had made that kind of an error.
Yeah, especially over the entire country. So we have a quick question, because then I'm going to turn it over to a discussion. So Adam Eagle had a statement about Black Swan. It's still a Black Swan event, just this time for shippers. So that was mainly a dig at kind of the hot take culture that we try to avoid, right? Where every other day the market's crashing, the market's up, it's a bull run, it's a bear run. I'm sure we can get thousands more viewers if Ned, Dean, and I sat here and just said Black Swan every 5 seconds for 45 minutes. But yeah, you're absolutely right. It's been, if we're going to use that nomenclature, it's been kind of a triple Black Swan, right? March, the restocking boom with toilet paper and paper towels and canned goods. And then April with social distancing, freight was at kind of a 5 to 10 year low. And then now this just unprecedented bull run up, testing stealings we've never seen in modern spot rate history. So it's been a wild time. It's been hard to predict. I think responsiveness and your ability to kind of read the tea leaves in real time is I think what's going to set you apart. So I want to kind of kick one more question off, because Dean's been getting a ton of really good insight talking with folks in the industry about kind of some of the color behind what's happening in spot rates. So could you hit us with that real quick, Dean?
Yeah, just it's the unevenness in the market that I've been watching. And, Bill Cassidy wrote a great article on truckload capacity this week, and it got me thinking about why are we seeing a record number of load posts and trucks searching for loads in the spot market if freight volumes are kind of flat to down. and what got my attention was the 34% increase in inbound imports from Asia for August, June through August over the summer, and what I've seen is that a massive influx of e-commerce freight is starting to hit fulfillment centers and distribution centers, and it's creating these choke points. And what I'm seeing through social media contacts are these massive lines of trucks. And I talked to some brokers and carriers this week, and a friend of mine spent 4 days under one load after 266 miles. So it was 266 miles for a one-way haul. He spent 4 days trying to get it unloaded. There were hundreds and hundreds of trucks lined up. They couldn't take the volume of freight at this particular distribution center. Now, the point is that while he was getting detention and layover pay, his truck was effectively sucked out of the network. So the available capacity took a hit. And I just wonder whether that massive surge of e-commerce freight multiplied across all of the distribution centers and warehouses is actually impacting the capacity as the revenue goes more towards accessorials and less towards rate per mile as trucks are sucked out of the network.
You know what, though, Dean? I mean, I think that it's almost like Schrodinger's rate ceiling, right? It's like we're only reporting out line haul in our numbers to kind of smooth it and make sure that it's even and consistent. But in reality, those rates could be bumping up 250, 270 a mile when you include detention, hazmat reroute, redelivery, conveyance back to take your break and then try to redeliver. I mean, all those things could be pushing hundreds of dollars into each load, right?
Yep. And I think that's why capacity is both tight and loose at a commodity and market level. It's not just the whole freight market. There's so much imbalance as I talk to carriers and brokers at the moment. Yeah,
for sure. I think that word it was an interesting conversation. I think it was on LinkedIn last week. Imbalance does mean different things to different people, but it's interesting. Like I think that the color around what we say when we mean imbalance, I appreciate you able to provide that. Were you going to say something, Ned?
Yeah, no, I had just a quick question. And I remember when the ELD mandate was being rolled out, there was a lot of discussion on the shipper side of trying to find more efficient ways to kind of load and unload. Do you think that there's still some juice in that orange about, I remember folks talking last week about trying to do like power swap or some other kind of a trick to let you load and unload faster?
So it's a question to me, Ned.
Yeah, no, that was a question to you. Yeah, do you think that there's a lot of overhead, a lot of ceiling that shippers could be investing in to try and move that freight through faster?
From what I've seen on the shipper load boards, comment boards, the answer is no. I think there's been a fixed level of infrastructure that's been built for a fixed volume of inflow and outflow of goods. I think warehouses are at peak capacity. And that's what's causing the problem. They can't build new warehouses quick enough to move closer to distribution, closer to populations. So I think the existing infrastructure is bursting at the seams right now, and that may be just a function of pre-Labor Day, stocking up of retail season for the upcoming holiday season. This could just be a bubble, but I think they're trying to do the best they can with the existing infrastructure they had in place.
Yeah, I think that pressure release valve, Ned, I've seen in my past is detention, right? Around the ELD mandate, there was a lot of talk around. I mean, I almost fell off the podium. I was giving a presentation at a carrier event, and an owner-operator raised his hand. He goes, "Where do you think we're going to be with geofencing so we can accurately capture detention down to the minute?" And I'm just like, wow. I mean, yeah, when is that going to come, right? Because it's every minute counts. When it comes to that. So I'm getting the old shepherd hook from our producer, so I'm going to wrap things up here. I appreciate everyone who tuned in. We will be posting this out as a recording for those not able to catch the live show. There'll be links down below. We'd love it if you'd like and subscribe. It really helps get our content out to more folks. I have a couple other links. So dat.com/market update. Dean's update continues to be just a wealth of information. I've seen those charts and graphs pop up on dozens of other brokers' market updates and being used by websites and stuff like that. So it's free. Take advantage of it. Dean does an excellent job. And then askiq@dat.com. If you have any direct questions for us or if we can help you out in any way, we are more than happy to do so. But with that, we don't have any outro music. I'm a terrible singer. We're trying to negotiate the rights to like ZZ Top's LaGrange or some other big hit, but I don't think that's in our budget. But with that, I'm going to sign off for this week and thank Ned, Dean, and Cynthia for joining us. And take care, everyone, and be safe.